This is the 12th installment to the series entitled Build Your Business into an Asset of Value. Revenue is vanity. Profit is sanity. But cash is king. As business owner and manager, you need a single page of information to look at each day with which to assess the financial health of your business. A dashboard populated with up-to-date information derived from your financial statements and more specifically your management accounts is the answer. In this chapter, I address financial controls for the day-to-day running of the business. However, the topic of this book revolves around value and particularly shareholder value. In the last section of this book, I address business valuation in detail. Every business owner should design and develop a dashboard populated with information that best serves the nature of their business. What follows is an example of a simplified financial dashboard. The first item is total sales revenue. How well is the business doing in terms of sales, specifically in relation to its sales targets? I like to include a formula. Sales revenue as per the profit and loss statement over projected sales revenue as per the sales forecast or budget. Henry Ford said, "Nothing happens until someone sells something." I recommend that the dashboard reflect the following: current value of total sales revenue, projected value of total sales revenue, and year-to-date value of total sales revenue. The next item is revenue collection. How well is the business doing in terms of collecting sales revenues? I like to include a formula: revenue collected over total sales revenue, where revenue collected is per the cash flow statement, reflecting the actual cash flowing into the business in the form of sales revenues collected from paying customers over the accounting period, and total sales revenue as per the profit and loss statement, reflecting the sales transactions for the accounting period. I recommend that the dashboard reflect the following: current sales revenue collected and year-to-date sales revenue collected. The third item is outstanding debtors. How well is the business doing in terms of collecting sales revenues from its debtors? As per the debtors book age analysis, I recommend expressing this value in monetary terms and per days outstanding, 30, 60, 90, and 120 days outstanding. The next item is outstanding creditors. How well is the business doing in terms of honoring its commitment to its suppliers? As per the creditors book age analysis, I recommend expressing this value in monetary terms and per days outstanding, 30, 60, 90, and 120 days outstanding. The next very important item is cost of sales. How well is the business doing in terms of managing the cost of sales? I like to use the information included in the cash flow statement. I recommend including the following: current value of cost of sales, projected value of cost of sales, and year-to-date value of cost of sales. I also recommend including a forecast of when cash is expected to leave the business to fund the cost of sales over 30, 60, 90, and 120 days. Then, very importantly, operational expenses. How well is the business doing in terms of managing operational expenses? You can get this information in the profit and loss statement, but I prefer the information as reflected in the cash flow statement. I recommend including current value of operational expenses, projected value of operational expenses, and year-to-date value of operational expenses. I also recommend including a forecast of when cash is expected to leave the business to fund operational expenses over 30, 60, 90, and 120 days. Then, one of the most important measurements, cash reserves. How well is the business doing in terms of maintaining minimum cash reserves as per the cash flow statement? I recommend including current value of cash reserves and projected value of cash reserves. I also highly recommend including a forecast of cash reserves over 30, 60, 90, and 120 days. The last item to include is profitability. I recommend the inclusion of 3 profitability ratios. Gross profit margin is equal to sales revenue minus cost of sales over cost of sales. All this information as per the profit and loss statement. This ratio reflects the profitability of trading activities. There is no fixed rule as to what value is acceptable since industries differ. What may be important to note is that financiers providing trade finance solutions will express concern when the gross profit margin of a business is below 30%. The next profitability ratio to include is operating profit margin, which is equal to operating profit over total sales revenue, as per the information reflected in the profit and loss statement. This measure reflects the value of profits after deducting operational expenses, but before interest and tax. The last profitability ratio to include is net profit margin, which is equal to net profit over total sales revenue. All of the information reflected in the profit and loss statement. This measure is super important because it shows how much net profit the business generates for every R1 of sales revenue. In conclusion, implementing financial controls allows the business owner to set goals and monitor progress. But business systems must be set up in a way that accurate, up-to-date, and meaningful information flows to decision makers. Thank you for watching. To access the full series, visit Constructive Online Learning on YouTube or click on the link in the post.